Alrighty, greetings everybody and welcome back to another wonderful Monday discussion. Today the date is November 26, 2018. Today we're going to be covering Trader Psychology 101. It's a very crucial topic. It's something that I find a lot of traders tend to not give enough attention despite being told the importance of it over and over again out of our careers. For some reason, many traders just have a very strong aversion to diving into the psychology. Everybody seems to be convinced that there's not nearly as much gain potential from it as, say, spending our time studying technical analysis. But without going any further, folks, we are going to first throw some disclaimers on screen, and then we'll dive on into that juicy material. Thank you guys for joining me yet again, as always. But let's go ahead and get through these disclaimers. First one I will read for you. The next ones I'll leave on screen for a short period. So starting off, guys, Earn to Trade is provided to you for educational purposes only. Earn to Trade is not a financial services company. Earn to Trade does not accept any liability for loss or damage as a result of the reliance of the information contained herein. This includes educational material, price quotes, charts, and analysis. Please be aware of the risks associated with trading the financial markets. Never invest more money than you can risk losing. The risks involved in trading are high and may not be suitable for all investors. Earn to Trade doesn't retain responsibility for any trading losses you might face as a result of using the data shown on its websites or webinars. The data and quotes contained may not be provided by exchanges, but rather by market makers, so prices may be different from exchange prices, not accurate to real-time trading prices. Any examples used are not a recommendation to buy or sell or a solicitation to buy futures, options, bonds, or binaries or securities of any kind. The information and strategies and techniques discussed herein are the property of Earn to Trade LLC. They may not be shared or distributed to another party without the express written consent of Earn to Trade LLC. Any trademarks or copyrights referenced other than Earn to Trade are the property of their respective holders and not Earn to Trade LLC. Wonderful. What a mouthful. So next one, guys, just take a moment to read on through them on your own, and we will be on our way. I know that the disclaimers are always painful, but unfortunately required. All right, moving along. And keeping it going. And still we continue. All righty. Let's go ahead and get on our way. So jumping back to the title, for those of you that are joining us late, just to keep the screen pretty for one more second here. Trader Psychology 101 is the subject today for our wonderful Monday discussion. My name is Chris. I'm a trader and mentor here at Earn to Trade. I do these discussions each and every week, as well as our daily market recap videos. And most importantly, I am mentoring with all of you fine folks. It's something that I do enjoy doing. So many of you already are familiar with me, but if it's your first time joining me or listening to this, then hey, how are you doing? And that's a little bit about me, and it's a pleasure to have you. So here we are. Today's subject is one of naturally more mental nature. We're not going to be, it's not so much of a visual presentation today. I can't show you psychology in the markets directly per se, and because of that, there's not going to be as much excitement going on my screen that you have to worry about, but it's more so the thoughts and ideas that we're presenting. I will throw a notepad on screen that I'll probably throw some notes on myself. Now also know that while I strongly encourage taking notes, just for helping solidify the information, it isn't necessarily required because this is being recorded, so you will be able to watch it back at any point in time. So no pressure there, just in case I get going quickly. If you have any questions as well, definitely go ahead and ask them as we go along. I most likely will not stop and answer it directly, but I will try to find a way to organically kind of put your answer into whatever it is that I'm talking about to try to have all your questions answered. And if I, by any reason, haven't found a way to do that, I will directly address your question at the end as well. So here we go, folks. Switching on over to the charts. There we are. Wonderful. So the subject, Trader Psychology 101. Now, what I'm probably going to do here is throw this notepad up, and we're going to talk about some different topics. And we're going to break down what it is that I mean when I'm talking about Trader Psychology 101. And I'm going to bring up a lot of mistakes that traders make with the psychology aspect that cost them in their trading careers. It's much more common with newer traders, and it's almost I'll say that it's very rare that you ever hear of a new trader avoiding all of these mistakes entirely. Almost all of us have experienced some of these. And as a matter of fact, if somebody tells me that they haven't experienced any of these at some point in their trading career, I would be strongly suspicious, folks. These are all things that I've personally experienced as well along the way, and it is okay. And this is the most important thing that we understand off the bat. If you are currently have done any one of these things, it is okay. Know that you're not alone. We've all done it, but we do need to talk about it to know when those things that we're doing are mistakes if we're not aware of it, and just save us. At the end of the day, our end goal is all to get better, and these are pretty big leaks in our play. So the first thing, most new traders do tend to start out. We're going to call this one analysis paralysis. Here we are. So number one we'll put down is analysis paralysis. Why is my font looking so crazy? It's quite the font there, but I like it. We'll rock this one. But anyway, analysis paralysis. All right. So what is analysis paralysis? What in the world am I talking about? I actually have to change this, folks. I apologize. This font's giving me a headache already. Let's go with a nice soft one here. That's much better. Okay, analysis paralysis. Sorry about that. So most new traders do start off soaking up all that information. They use a million different things to just pull in information about what it is that they're doing, and they try to build a strategy, or they find a strategy and they start implementing that strategy. Well, you hear about Bollinger Bands, for example, a technical analysis strategy that's very common for traders to utilize in trading to execute trades. So the new traders are soaking up as much information as they can possible to figure out how they can place a trade. They're always looking for the how. What's going to give me a trade? What is my signal? That's what's going to tell me that the market is going to or what's going to indicate to me that the market's going up or down. That's their system. That's what's references their system. The problem is new traders tend to completely disregard the way statistics and probability work, and more or less they'll start testing something, and in a small sample size, maybe they have 6 losses. Maybe they have 6 losses and 1 win, and they immediately disregard the system, which is a system that, say, wins roughly 65 to 70% of the time. Well, having 6 losses and 1 wins, while that's not what is expected to happen on the grand scheme of things, but it's entirely possible for that to happen and still maintain that percentages in a larger sample size. And what happens is the trader then goes and throws things away immediately just because they are experiencing short-term defeats and fail to understand that we need a much larger sample size as traders to accurately measure what's going on. And the beautiful thing about this is that doesn't mean we have to spend all kinds of money in order to get that large sample size either. We all are aware that demo accounts are a very, very paper money accounts are a very, very, very beneficial thing to us as traders that are working on things and testing this out. It allows us to trade the market and make decisions exactly as we would be able to do with our live money without risking any live money. So we are able to accrue these sample sizes. So there's no reason besides laziness or lack of patience that causes the analysis paralysis. It's basically not giving our analysis a chance to work and changing it so rapidly that we're permanently paralyzed and stuck in a situation where we are constantly not working because we're switching to something new, and every time we switch to something new, we have to go through that period of not working. Most everything that we start out with as traders using for the first time, even if it's a proven winning strategy, is going to start as a failing strategy until we truly understand how to use it and truly understand how to implement the rules and adhere to the rules and the things to look out for. Most everything starts out failing, and in order to get something working, you have to spend some time using it. So that is something that we need to avoid, is the analysis paralysis. And what goes into this, and a big part, we'll make this a number 2, is except that the market is random. Okay, obviously to a degree, folks, but we need to understand that variance will occur. That means, and this kind of ties in with number 1, that means there's going to be times, even if we're using a strategy that wins, say 65% of the time, say 75% of the time, we're winning. So we're winning 3 out of 4 trades. Say we're winning 3 out of 4 trades. We need to understand that that doesn't mean that that our trading logbook is going to look like 1 win, 1 win, 1 win, 1 loss, 1 win, 1 win, 1 win, 1 loss. It's not going to stay that way perfectly. There could be times where we win 10 trades in a row, and there's also theoretically, it's also possible for us to lose 10 trades in a row. Would be a very good day, but nonetheless. So it is possible to understand how probability and how the statistics work, and understand that the market in and of itself is random in the sense that it only takes one person, one industry with a large enough amount of capital to completely throw out your prediction in the market, your expectation that because there's an area of support being found here that you're interested in buying in the market, and maybe there's a bunch of other traders like you that are also interested in buying at this level because they've noticed support in the past, and as a result, because of everyone buying, we then see the market begin to rise because of the expectation that it will rise. We then make it rise, but it is still possible that somebody wants to do the opposite, and someone with a large enough amount of capital, or some people with a large enough amount of capital, are able to do that. And because of that, the market doesn't always do. Everyone is not always in 100% agreement, and sometimes you're going to agree with the losing side. And we need to understand that everything isn't always going to go our way. And despite that everything isn't going to go our way, that doesn't mean that something needs to be fixed. Okay, there's going to be times where, you know, your ideal perfect strategy isn't going to win, but that doesn't mean there's anything at all wrong with that strategy, and we don't need to scramble to find out, you know, what we're going to do to solve this problem. Now, I'm not saying we should not analyze every single loss. That's not what I'm saying at all, but we need to not over panic is what I am saying. And we don't want to ruin a good thing because of something that is going to happen. It's not a matter of, you know, is it or isn't it? It is going to happen. There will be losses on every single strategy because of that random factor, that anomalous factor that the market does adhere to, because once again, not everybody agrees. We know this. This is life. Nothing new here. Okay. Another thing is we need to let's throw in for number 3 a common trading psychology mistake here. Review your equity curve. Okay, people spend a lot of time analyzing their individual winners and losing trades, looking for some sort of insight that will help them crack the code. Maybe if I choose a different moving average, or if I cut my losses earlier. These are all helpful things when looking at one or two trades, but how would this impact all of your trades? Have you honestly maintained the same system long enough to even analyze how minor tweaks could help? For me personally, for reviewing individual trades is critical, but even more important is the review of our equity curve itself. This allows us to take a bird's eye view of our trading performance. And the crazy thing is, if you plot your equity curve, you will see some of the patterns that you see in price charts. If we say hypothetically that in the year of 2013, I had a quadruple top at 70% return. If and right now I'm sitting around 50%, and over the last 3 months, every time I hit 70%, I would have a nonsense trade that backs me off my high, and then I quickly march right back up there again just for it to be denied. This is an example of what I'm talking about in terms of just plotting that equity curve. It's important for us to not go crazy over the short term when we're looking at our equity, when we're looking at the returns that we're getting. It's not for us to, it's on both positive and negative aspects of the coin. We don't want to say, okay, we made $10,000 yesterday. We made 10,000 yesterday. Say we made 10,000 for the month. Say we made 10,000 for the year. Whatever level of trader that we are, we don't want to look at that and say, okay, we pulled it off yesterday, and we should never expect that we're going to pull that off every single day forever and ever and ever. Now, on the same token of that, we also don't want to, count off that we can't. It's obviously our goal, and it is absolutely possible, but we need to understand that we will have peaks and we will have valleys as we move. And what the goal is as a trader is we want to plot out our overall progress and be able to maintain that positive overall progress in between those peaks and valleys. We should still have an upward trending angle, and it's important to be realistic with what that upward trending angle is and not lie to ourselves. We need to pay attention to those peaks and valleys and not ignore our losses, and we need to not overly bolster our wins. We need to realize where our overall real progress is, and what is actually realistic based on our track record. Just because we can say we're profitable traders for the month, to this degree, are we actually profitable to that degree? Are we really actually pulling a 70% return just because we're able to do it for this month? Just need to be real with ourselves. Let's see what we're going to go ahead and throw on the board here for number 4. Let's see. We'll do. Let's cover the risk aspect, shall we? Going through my notes here. I apologize. But truly accept the risk. So, some of you that are here listening right now will say that you always, or might think that you always place your stop and are willing to lose the money. And while you might say this, you really don't want to lose the money. You'll place your stop out there, which could be pretty far off from your entry price. And over the next couple of hours or days, depending on your time frame, you will slowly move the stop up because the stock is not acting properly. So I'm just going to keep moving it up. And sure enough, at some point, your new stop order is triggered right before the market takes off. And if this has happened to you, it is one of the most frustrating events that can occur in the market. So your analysis was right. The market went in your direction, and you just kept moving it up because you're getting scared of what was going on. The market, the market gave you what you expected. However, you were not willing to accept the randomness of the market and the fact that you could lose the money. So the risk scared you out of the position because of how it was acting. So we talk about not being overconfident at times too in other areas, and we're going to get to more subjects along that line. But we need to accept the risk, and that means not just do something and say we just set off the stop loss level, at this location, and we set this trade going. We need to not be afraid of our position and close it early just because the market is just doing something within the boundaries of our stop loss and take profit. Understand? So we're not looking to be scared out of a position. When we place that trade, we should be doing our homework ahead of time. We should know exactly how much we're willing to risk in order to achieve how much. We're predetermining our drawdown that we're willing to accept in order to reach the take profit level that we're hoping the market will rise to, which means when we place that trade, we're making a statement that we don't care anywhere the trade goes within the boundaries of those two distances, and we want it to go to obviously our take profit goal. We want it to go, say we're taking a long, we want it to go up. But anywhere in between until it gets to up doesn't matter. It only matters if it goes to or beyond, obviously, our stop loss. At our stop loss, the position is closed. But what happens in between doesn't matter. The position is open. The position is open. We have the position open because we made the prediction ahead of time. The prediction is just in progress. We need to not be our own worst enemies and close a trade or start moving the stop loss higher and higher because the market starts looking, quite strange. A lot of times us being scared of the market causes us to make incorrect decisions, and when all of along the trade that was placed ahead of time had all of the homework done ahead of time, all of the analysis done ahead of time, and a lot more time was spent into it than we start giving once we start getting scared of the way the market's moving just by analyzing micromanaging every single bump or jolt that the market is experiencing along the way. I like to call it set it and forget it, or let it go. Execute the position, set it and forget it. We do our homework ahead of time. We can set it, we can let all of our levels go, and we want to try to forget about it. Obviously, we want to be responsible here as traders, but we want to try to forget about it and let our homework give us a grade. Instead of trying to change the answer. It kind of falls under the psychology aspect. A lot of times you'll hear people say that when taking a test, when you change your answer, a lot of times, statistically speaking, your first answer was the correct one. So just like trading, our first decision, our first analysis, or the first analysis that we made, a lot of times that is where the market is looking to go, the one where we spent most of the time calmly doing it before we were emotionally involved because we had no positions open, or compromised, I should say. But yeah, set it and forget it. So truly accepting the risk, important one. So also, and just as important on the counter side of that coin, whoops, didn't mean to add that there. We have knowing when to take profits. Excuse me here. So we have a situation, and that is knowing when to take profits as traders. So what is your trigger for exiting a trade as a winner? Ask yourself that. Don't, and it doesn't need to be some nonsense about this or that key level, unless you are intuitively trading for profits, which are probably less than 1% of the trading population. How exactly do you book your profits? And again, this concept sounds simple enough, the idea of knowing when to take profits. But when you factor in that most traders have an expectation of the market, or more or less of what the market will do next, meaning our analysis, our forecast, if you will. I'm sorry for the stutter in there. This makes it almost an impossible task. For example, in a few years back, a business partner of myself, we went long put options on the DIAs, and we had about 200,000 in profit. And up to this point, we had executed our trading plan flawlessly. At the time, we expected the Dow to hit somewhere around the 6K, 7K mark, which ultimately it ended up doing. But for this fight, the bears did not have enough energy, and instead of listening to what the market was telling us in terms of the correction that was currently over, we held on for what we expected to happen. This crucial mistake meant that instead of coming out of slightly north of a very nice gain, we ended up losing on the position entirely. And afterwards, we talked about this difficult experience for both of us, and understanding that we had the time to take the profits became a big subject between us, wondering why we didn't take what we had just because we were trying to get too far along. So we need to be realistic. Just like we need to be aware, we need to not be afraid of the markets, we also need to be aware when we are very certain of the markets that we're not being overly greedy just because the market has momentum. So say we set a take profit, and this is what I'm talking about here. I'm going to break this down a little bit easier. So say we have a take profit level set at, say, 1.3600 on the euro versus the US dollar, and the market's rising up to it, rising up to it, rising up to it, and it starts rising up to it a lot faster than we were anticipating gaining. But as it gets closer to that level, it starts to run into a little bit of resistance, starts to slow down a little bit. But because of all the energy that it had coming up to it, we decide that the market is going to keep going farther. So we want to, we want to move that take profit level higher. Now, in order for it to go higher, we have to now move that take profit level above some key areas of resistance that the market has encountered in the past. And this all of a sudden changes the entire dynamic of our trade and the analysis that we might have given ourselves before we executed the position. So us getting greedy and just saying, oh, the momentum is going to blow it through all of these levels can cause us to miss out on our initial profit that was going to be easily achieved anyway because we thought it could go so much farther and kept moving our take profit level higher. That's more or less what I'm trying to get at here. Now, there's a few different ways, obviously, that you could take it as well. Is, you could also, there's also going to be times where the more experienced traders will be able to recognize that price might be getting stuck just under their take profit level, and it might be a good idea to just actually close the trade in the position due to the expectation that some hard resistance might be getting ready to shut the market down if they're in some type of a long. So it is important in that aspect too. That's going to be more of an experienced trader thing than a newer trader thing. The newer traders will tend to do it, and the newer traders will actually end up shooting themselves in the foot a little bit more, like we were talking about previously, than the experienced traders will. So it's something I generally recommend more so to only the experienced traders. But another important aspect that we're going to move on to in trader psychology of itself is going to be a little bit of a typo there. Recognizing when you are wrong. Okay, it's important to understand that while we're trading, that if we're finding that we found some system, so say we found a system and it was winning us every single trade right off the bat. Beautiful system, and this is when this happens the most, I find. We've got ourselves a system that's just doing so well for us, and maybe it just gives us a killer week, and it is just awesome. But once again, I said a killer week. I didn't say a killer year. So say maybe the system gave us a killer week. We tend to get extremely attached to that system, and we start to give it a little bit more credit than the sample size of data should give. So we only have a week's worth of trades. We don't have a very large amount of trades during that week, perhaps. Maybe we only had, throughout that entire week, maybe we only had 15 trades. 15, 20 trades. We're not giving ourselves a very large amount of a large sample size in order to really give it the credit that we seem to be giving it. But because our experience with it, because in our mind our experience with it is only positive, we associate it as a very positive thing. But realistically, we may have just had a very lucky variance streak with the system that could actually be a failing system. So we don't want to get overly attached to something just because it did well for us in the short term, just like we don't want to run from something just because it didn't do well for us in the short term. It is important to give ourselves these sample sizes. It's important to test things to a large sample size to give something proper analysis. And this means we don't want to, and for some reason this does seem to be a lot harder on traders, we need to be able to recognize when we are wrong and not start lying to ourselves and start saying, oh, it's not working because of this or it's not working because of that, but it is a winning system, and base all of that on that small sample size that had on the beginning. If we aren't losing, folks, guys, or if we're losing, folks, it is important to understand that we're losing. That's okay. It is okay to lose as long as we recognize that we are losing, and that's the first step to beginning to change what the issue is. We don't want to become just horribly allegiant. We don't want to become Oh, sorry about that, folks. Think my microphone possibly cut out there. So hopefully we are still good to go at the moment. So moving along, point being, folks, we want to understand when we're wrong and not lie to ourselves just because of a small sample size at the beginning. Okay. Something else we will throw in here. Don't discriminate. Don't discriminate. What do I mean by that? When we're trading the markets, we have a strategy. Say we have a strategy that's a winning strategy and it's been treating us well. We'll say that it wasn't, it's a winning strategy. It might not be the most powerful strategy in the world, but it's doing well. And we're really proud of ourselves for finding and implementing this strategy. And we should be. We should be proud of it, anytime we're implementing a winning strategy and doing well. But say we're, oh, excuse me, folks. I'm sorry. I apologize. I was frantically reaching to guard the mic. I'm very, very sorry. There was no one came out of nowhere. So the point is, if we have found ourselves a strategy that is doing well, we found ourselves a strategy that's doing well, but it likely has room to improve, but we're proud of it. If we were experimenting or for whatever reason, say something, we accidentally added, say a moving average to our charts, and we might have experimented with a strategy while the moving average was on our charts, we noticed that maybe we found a way to increase our accuracy, okay, with the position. If it looks like something has substance that if by adding it to our strategy, by modifying it, we don't want to fix something that isn't broken. However, we also want to be open to the idea that something might make it better. There might be a better way to do things. Just because it's a winning strategy doesn't mean it can't be improved. Now, we want to be careful with how we do this because, once again, we don't want to fix something that's not broken and then make it broken. But we also want to be open to the idea that things aren't always perfect and they can be improved upon. Okay, we don't want to stop achieving greatness, so to speak. That's the idea, and we don't want to become so allegiant to something that we start to think that nothing could possibly be better than it. Okay, so we always want to we want to be open-minded as traders, and in everything we do, we never want to stray too far one way or the other, but we also never want to close off possibilities. But anywho. What shall we go on next? Okay. The next thing that I'd like to talk about is pretty huge. Well, we'll make this one a big one here. This is a very big trading psychology must for us as traders. Well, trading psychology. Okay, and that's develop a winning attitude. This is huge. This is huge. Everything we've talked about is huge, but developing a winning attitude is very, 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 very large. So we all know what it feels like, hopefully, when we've had the crazy trading streaks. We've won like 14 trades in a row. We know how good that feels. We feel like we're on cloud nine, and it feels like we're just like connected with the market. We know every move the market's going to make, and it feels like we can do no wrong. Okay, and then we also know what happens when we get in the opposite attitude. The yin to the yang here, or the yang to the yin, if you will, because it's the negative side. So when we get into that mood and it feels like we can't do anything right and we lose quite a few in a row, and no matter what, the important thing to understand is, folks, that yes, the market, there is variance involved, which means there's going to be times where no matter how good we are, we will still have times where we lose. No matter how good we are, listen to me, folks, no matter how good we are, there will still be times where we lose. Now, can we control that? Absolutely not. We cannot currently control that whatsoever due to the way the market operates, nor will we ever be able to control that to that degree. Now, If we understand that we can't control that, so we're going to let go of that thing that we can't control to that degree, but what can we control? We can control keeping ourselves into the correct mindset, into the correct mode that is allowing us to continuously win those trades. If we were, think of it this way, that feeling that we get when we're winning all of those trades, it's almost like it becomes easier and easier after every win to win another trade. So we have one trading win. It powers us. It gives us a little bit of a slice of the cake. It drives our brain crazy. It lets us know that we're dialed in, and we continue to dial more and more in. We taste the blood, and we go in for the kill, so to speak. Sorry for a gruesome reference. So we're in a situation where we are, because we like, as humans, we like that positive dopamine release that we're getting from that. We're putting ourselves in a situation that's going to best allow us. We do this subconsciously. We put ourselves in a mindset that's going to best allow us to feel that reward again, because we are liking what's happening. And as such, it actually allows us to win our other trades easier, because it is putting us into that correct mindset in order to be more likely to give us that feeling yet again. Now, the opposite happens when we don't win trades. When we don't win trades and we go on those losing streaks, we don't like it. Our body says, ooh, I don't like this feeling. I don't like this stress. I don't like this feeling. It's not making me feel good. I don't want to do it. I don't want to be subjected to it. And what happens is the body starts to go into that situation where it's the opposite. Instead of trying to reward you to let you know to keep doing it, your brain starts saying, oh, I don't like this. I'm going to make this feel unenjoyable. You're going to be in a situation where you're now really, really angry. You don't like what's going on. You're not going to like everything, all that other stuff. And we all respond to things obviously differently. But the point is, we put ourselves in a mindset that is not conducive to winning, because it is trying to avoid the situation of losing. So what we can control at the top of the gears, all of us that are, the controllers of these big goofy arms and legs, what we want to control those big arms, legs, and fingers to do is we want to put ourselves into a correct mindset. We want to keep ourselves as much as we possibly can into the winning mindset. We want to always feel like we are winning. We want to always feel like we are, controlling the market. We want to be in that situation, and by feeling that way, we will then act that way. We will do these things. It'll keep us from making all these crazy mistakes. And instead of having that crazy adverse reaction when we lose, we can, instead of letting it control us and think it's it's going to drive us down, we can stay in that happy, correct, healthy mindset. We stay in that mindset, and we keep doing what we know from our statistics, from our math, from everything along the ways, from all of our homework, what we know to work. We don't get bothered by the losses, because we know we're winners, and we're going to continue to win. We stay on that correct playing field. We stay in that right mindset that allows us to continue to stay on that correct track, that positive track, and keep winning. We allow ourselves to keep winning. We empower ourselves. Mental attitude is extremely important. It's not just hippy dippy stuff, folks. This is a huge part of trading. It's a huge part of life in general, but it is a huge part of trading. We need to develop that winning attitude and feel like a winner. In order to be a winner, folks, you got to feel like a winner, okay? And you don't always feel like a winner, and that's normal, and that's okay. You need to recognize that it's okay to not feel like a winner, and then begin empowering yourself to feel like a winner, and just go down that road and allow yourself to have that success. That's where we want to be at. But other than that, folks, it has been a pleasure as always. I do enjoy doing these Monday discussions with all of you. Once again, if you did join late, my name is Chris. I am a trader and mentor here at Earn to Trade. A lot of you are already familiar with me, but thank you for joining me for another Monday discussion. Today we talked about trading psychology, some of the things that we don't want to do, some of the things that can allow us to be better mentally, so we can be our best traders ourselves when we are physically operating at that computer or terminal, or whatever it is that we're using. But it is crucially important, and so much it is so important. It is something that no one should ever overlook. Some of the largest determining factors in a trader being profitable or unprofitable is broken down to the psychology and not to the physical properties of what they're actually following. So other than that, folks, thank you for joining me again. I am going to bring us to a close. This has been another discussion brought to you by Earn to Trade. My name is Chris, and I will see you all real soon. Cheers, everybody.